We're using ratios to understand final accounts, and today we're going to look at return on capital employed. We're going to call this ROCE most of the time. This is a really important ratio. Will show you how well the money that's been invested in the business is being used, and I'm going to come into that in a little bit more detail in a while. To calculate our ROCE, we're going to be looking at two different sources of information. First of all, the income statement or the profit or loss, and secondly, the balance sheet, which sometimes is called the statement of financial worth. We're going to combine information from two sources. First of all, we're going to look for profit before tax. You will find that on the income statement. We're then going to take equity or net assets, different word for it, same thing. We're going to find that on the balance sheet. Bear in mind, this is sometimes called total equity. We are going to look for our non-current liabilities, our fixed liabilities, our long-term loans. We're going to also find that on the balance sheet. So for our example, we're going to say £75 profit before tax, £200 is the worth of the business, and £100 is the long-term loans they have. So the calculation we're going to use is profit before tax divided by capital employed times 100 equal to return on capital employed. Now, you don't know what capital employed is, so that's the first thing we need to find out. To work out capital employed, we take our equity, how much the business is worth, in our case 200, and our non-current liabilities, our long-term borrowing, which is 100, and that gives us £300. Pretty much what we're trying to work out is how much money is involved in generating the profit for the business. That is why it is called capital employed, capital which is being used up. We can now put these figures into our ROCE calculation, and we will have 75 profit before tax divided by 300, which is the capital employed, times by 100 to make it a percentage, equals 25%. So basically, each pound invested in this business will generate 25p. Now, this is a tricky concept, and we really need to think about what this actually shows us. So I'm going to use two examples here. Business one, capital employed. They've got £10,000 involved in generating profit from the business. They generate £1,000 profit. So the 1,000 divided by 10,000 times 100 gives us a 10% return on capital employed. For each pound invested, it generates 10p. Business number two, same profit level, £1,000, different level of capital employed. So we have 1,000 divided by 100,000 times 100 equals 1%. So for each pound invested in business number two, it generates 1p. So business one is better than business two. Let me explain why. So if we had £100,000, we could have 10 business ones for the price of one business two. 10 tens is 100, obviously. So this means if we had 10 business ones, it would generate 10 times £1,000. The profit wouldn't be £1,000, it would be £10,000. But if we invested our £100,000 in business two, we would only produce £1,000. So business one has 10 times the return of business two. So ROCE is a very good indication of how well a business is being run.